near $400 to an ounce. So you're talking about really rapidly growing up or down. I mean, if you bought, you made. If you sold, you made. If you played the game right and you bought in at the right time and sold at the right time, you would have hit double digits. All right. But ultimately, he knew exactly when to jump in and when to execute his trades. And this is something, as I said, is not easy. It's something that you will have to learn. You'll have to identify, and you'll have to specialize in a specific area. So aside from his keen analytics and his steely resolve, okay, what was the key to Roger's success was that he actually used no leverage in his trades, but by not employing margin, Rogers never actually put himself at the mercy of the markets and could therefore liquidate his positions. So when he actually chose to do so, rather than when a margin call was forced, rather than when a margin call would then force him out of the trade, but by not employing leverage on his position, Rogers was not the only able to really stay in the game, in the trade, but he was also able to actually hold it to a higher level than it was created at a better overall blended price. Okay, so the slow and the low is actually the way to go. All right, and for currency traders, the Rogers trade in gold actually holds many lessons. Now, experienced traders are actually familiar with being stopped out on or actually margin called from a position that was going their way, and really familiar with being stopped out just because of those reasons, not having the right sort of capital because leverages are off, the leverages are too high. So you need to really identify your position before making that position, understand your your leverages that are there to essentially give you more profits, or alternatively work the other way around. So the key is understand what margin call is, understand that you need to stay in your position. If you've identified something and you want to execute and you want to follow through it, make sure you keep your eye on your margin. As it comes towards the 100% mark, then there may be a margin call that may call and wipe you out of your position. Now, that's the last thing you want. All right. So, to really better illustrate these points, okay, we have a image that actually, once you look at it and you look at these 3 points, you're actually waiting until the RSI drops through the 70 proved to actually be a much better timed entry than either of these. Okay, so so the key is, again, finding the right place to actually buy in, identifying your trend, and making sure that your psychology is right, that you don't get scared out of your position if your position is essentially going in the same direction that you've analyzed and you have indicated your price exit points. Then I would hold those positions and ultimately look for the mark where you can potentially make more money. I mean, that's the key, right? But it's not always the case. So it's not necessarily an issue as long as you have purchased in one of those points and you exit your position in a very timely manner. Okay, so really timing is the vital ingredient to success and successful trading. But traders can actually still achieve profitability even if they're poor timers, or as I said earlier a second ago, by identifying the market direction and the trend and identifying certain indicators that are telling you to actually jump into a position and you see your exit points, then execute on that. Don't waste the time, actually execute on what you believe. Now, if it doesn't go your way, trial by error, practice makes perfect. You're gonna have to do better next time. Okay, it's as simple as that. So as I said, it's a vital ingredient to really try and still achieve some profitability, even if the
even in poor times, okay, where you jump into the market at the wrong time, even if you can take a small percentage of that margin or that profit that you were essentially going to get if you bought it in a little bit earlier, you're still going to close with a profitable position. All right, and exit. Well, real key is to exit that position on a green spot. But of course, with psychology and greed and fear, don't get too greedy. Is the other thing. You may have identified it. You may want to execute the position or exit the position at a specific mark that you've already identified. Then what I would do is I would follow through with the exact strategy that you started the position with. Try not to adapt or change the strategy. Follow through and execute it. So the real key to success actually lies with taking small positions, using low leverages, and really to ill-timed traders that can actually have plenty of room to absorb any type of adverse price action. So when trading without stops is never a wise strategy. As I said, risk management is crucial, and that's why even the poor timers should really adopt a prohibitive approach to the methodological that actually keeps trading losses to a bare minimum, while allowing the traders to actually continue and reestablish new positions and different positions. All right, so that's timing. Now let's actually have a look at fear and greed and how that actually consumes the soul. So there is an old saying, which I'm sure that you've all heard before, on Wall Street, that the market is actually driven by two sets of emotions: fear and greed. So although it's an oversimplified simplification, it can actually be true. So really scumbling to those emotions can actually have a profound and determinal investors and portfolios, as well as the stock in terms of the market. So when you're investing in the investing world, one often hears that you've got a juxtapox position, okay, between value, index, and growth investment, and although the understanding of these two types of strategies is fundamental to really building a personal investment strategy. So what is key is it's very important to really understand the influence of fear and greed on the financial markets. And there are countless books and various different courses, of course, that are devoted towards this topic. So, here, my goal is actually to demonstrate what actually happens when an investor gets overwhelmed by one or both of these types of emotions, okay? So the first is greed influence, all right? And so often what you tend to see is you've got investors that get caught up in greed and excessive desire, all right? After all, most of us actually have a desire to acquire as much wealth as possible in the shortest amount of time. Now, the internet boom in the late 1990s is the perfect example, okay? And that's because at the time it actually seemed all an advisor had to really do was to simply pitch an investment with a .com. So at the end of it, the investor actually leaped at the opportunity, buying activity in the internet-related stocks, and many startups just reached a fever pitch. Okay, so investors actually got greedy, is what I'm getting to, fueling further with greed and leading to securities being grossly overpriced, which actually created a massive bubble, and it burst in the mid-2000s and kept leading towards indexes depressed through 2001. So this get-rich-quick scheme or mentality actually makes it a lot harder to maintain gains and really keep to a strict type of investment plan over the long term, especially aimed at such a frenzy
or as they say, former Federal Reserve Chairman, the Alan Greenspan. Okay, so let's put it in that aspect, the irrational exuberance, okay, of the overall market at the time. So it's times like these that that are, really crucial to maintaining an even keel or a stick to the basic fundamentals of investing, such as maintaining a long-term horizon, the dollar cost, averaging and over, avoiding getting swept by up the latest crazes that actually are announced out in the market. But another thing to learn and another lesson to learn from, for example, from the Oracle Omar, the Buffett book, we could actually remiss if we decided that the topic of getting caught up in the latest craze without mentoring or mentioning a very successful investor who actually stuck to his or her strategy and profited greatly. So Warren Buffett actually showed us just how important the beneficial of it to really stick to a plan in in times like the dot-com boom, for example. So Buffett was once heavily criticized for really refusing to invest in high-flying tech stocks, but once the tech bubble actually burst, his critics were silenced. Buffett stuck with his comfort zone and his long-term plan. So by avoiding the dominant market emotions of the time in terms of the greed, he was able to actually avoid those losses that felt by those who actually hit the bust. So interested in a number of different companies that Warren Buffett was actually buying and selling. So fear influence is just like the market that can actually become overwhelmed with greed. So the same can actually happen with fear, and an unpleasant, often strong emotion of anticipation or awareness of danger actually takes place. And when the stocks actually suffer large losses for a sustained period of time, the overall market can actually become more fearful of the sustained further losses that can then be taken. So the key is, but by being too fearful, this can actually just be a costly type of emotion, as it's as being too greedy can be too. Okay, just as greed dominated the markets during the dot-com boom, the same can actually be said by the prevalence of fear following its bust. Okay, in a bid to actually stem their losses, investors quickly moved out of the equity stock markets and in search of less risky buys where money can then be poured into and of course more into the market securities that are available. So stable value funds and principal protected funds at low risk and low return securities. So the mass exodus, okay, out of the stock market actually shows a complete this greed for the long term of investing plans that are based around fundamentals. Okay, so you've got investors that threw their plans out of the window just because they were too scared to actually come back into the game, and overrun by the fear of sustaining further losses was the main aspect of fear and emotion that was driving some of their brains. So really, when it's granted losses in terms of large portions of your equity portfolio were worth far too much in terms of a tough pill to be able to swallow, but even harder to really digest, even though that the new instruments that initially actually received the inflows have actually very little chance of ever rebuilding their wealth. So just as scraping your investment plan to the hope that that you stumble across the latest get rich quick investment, and can actually tear a large hole in your actual portfolio. So, to getting to be able to sweep up the prevailing fear of the overall market by switching to low risk and low return investments. This is it. This is the psychology. This is you falling down and having to pick yourself back up. It's like a baby riding a bicycle. Not a baby riding a bicycle, but a kid riding a bicycle. If a kid rides a bicycle and falls, is he going to give up, or is he going to get right back on that bicycle and ride it away? So that's the psychology, ladies and gentlemen. It's just like putting yourself back as a child, but except you're dealing with currency markets, you're dealing with stock markets, you're dealing with your own personal psychology that's evolved over the years in terms of your fear and greed factors. So these two emotional, psychological mindsets are, areas that you really need to be able to train yourself. And the only way to train yourself is by making these mistakes and learning from them. Okay? But look, easier said than done. So, you have to keep in mind that it really isn't as easy as it sounds, as I've emphasized already, but it can be done. And there's a fine line between really controlling your emotions and being just plain stubborn, okay? So what you have to remember also is to really reevaluate your investment strategy and allow yourself to be able to be more flexible to a point, and to remain rational when making decisions that essentially are going to be changing your plan of action. Ladies and gentlemen, that was fear and greed, and what we're going to end today's webinar on is Warren's mindset to his success. So what I'm going to do is I'm going to read out a number of points, and I want you to really imagine them. I want them to sink into your head, and I want you to identify how you could also utilize some of these formulas to your ideal trading strategy. So what I did was I selected a couple of bite-sized samples, okay, as really tips and suggestions regarding, the investor mindset and how you can essentially improve your stock selection that will, of course, help you to be able to get inside Mr. Buffett's head. So the first is think of stocks as a business. Now, what you'll find is you've got a number of investors that think of stocks and stock markets in general as nothing more than a little, piece of paper being traded back and forth among investors, okay? Now, this might help prevent investors from becoming too emotional over a given position, but it doesn't necessarily allow them to be able to make the best possible investment decision, all right? So this is one of the reasons why Buffett actually had stated that he believes stockholders should think of themselves as a part of the owner, all right? And of course, the business in which they're actually investing in. So by thinking that that you have, that the way both, Hagstrom and Buffett actually argue that investors should then tend to avoid making off the cuff investment decisions and being, or becoming more focused on the longer term investments, okay? Furthermore, long-term earners actually can tend to analyze situations in a greater detail and then really put it into a great deal of thoughts into a buy or a sell decision. So Hagstrom actually says and stated that increased thoughts and analysis tends to lead to improve the investment returns. Okay. Now the second is the increase of size of your actual investment. Okay. Now, while it actually rarely, if ever, okay, actually makes sense for any sort of investor to actually put all of their eggs in one basket. Now, putting all your eggs into too many baskets may not be as good as, as good thing as either of them, okay? So Buffett actually contends to exactly that over diversification of investments that can actually hamper returns as much as, the lack of diversification. So That's why, he doesn't necessarily invest in mutual funds. It's also another reason why he actually prefers to make significant investments in just a handful of companies. Now, Buffett is a firm believer that investors must first do their homework before they actually start investing in any type of security. But after the due diligence process is then completed, investors should feel comfortable enough to really exercise and dedicate a sizable portion of their asset to the stock or that instrument that they were analyzing. Now, they should really feel comfortable in a winnowing down and their overall investment portfolio to a handful of good companies with excellent growth perspectives. All right, but Buffett stands on taking time to really properly allocate your funds is further with his comment that it's just not about the best company, but it's about how you feel about that company. It's also if the best business you own actually presents the latest financial risks and has the most favorable long-term perspective. Okay, and this is why you would actually put your money into a 20th favorite business. Instead of adding money into one of the top choices that you have. Okay, so the third point is really reduce your profit turnover or your portfolio turnover. So rapidly trading in and out of stocks can actually potentially make an individual a lot of money, but according to Buffett, this trader is actually hampering his or her investment returns. And that's because portfolio turnovers increase the amount of taxes that actually need to be paid on capital gains, and of course boosts the total amount of commission dollars that must essentially be paid in a given year. So the oracle, all right, actually contends to what makes sense in the business, also what makes sense in stocks. So an investor should actually ordinarily hold a small piece of the pie or of an outstanding business with the same sort of tendency that the owner would exhibit if he or she actually owned all of that business. So then the investor must think long term. Okay, by having the right sort of mindset, they can then avoid paying huge commission fees, lofty short-term capital gain taxes, and of course they'll also be more able to ride out any sort of short-term fluctuations in the business, and of course to ultimately reap the rewards of increased earnings and or their dividends over a certain period of time. So 4 is really developing the benchmark, okay, the alternative benchmark. So while you have stock prices, okay, that may be ultimate barometer of a type of success or failure of a given investment choice, you've got Buffett, who actually does not focus on that metric. Okay, instead he actually analyzes the pores over the underlying economics of any given business or group of businesses. Okay, so if a company is doing what it takes to grow itself on a profitable basis, then the share price will automatically, ultimately take care of itself. So successful investors must really look at the companies that they own and study their true real potential earnings, and if fundamentals are solid and the company is actually enhancing shareholders' value by generating consistent bottom line growth, then the share price in the long term should then reflect on that. Okay, now the fifth is to really learn to think probabilities. Okay, so bridge, all right, is a card game, right? And in which most successful players are really able to just judge mathematically the probabilities to actually beat their opponents. So perhaps, not surprisingly enough, Buffett actually loves and actively plays the game, okay? And he actually takes the strategies beyond the game into the investing world. So what Buffett suggests that, investors focus on the economics of a company's or, that they own, in other words, the underlying business, okay, or instruments. And then, really try to weigh out the probabilities that, certain events will or will not actually transpire, much like a bridge player checks the probabilities of his opponents, okay, hands. And what he then adds is that, by focusing on economic aspects of the equation and not just the stock price, an investor will be more accurate in his or her ability to be able to judge probability. All right. So thinking in probabilities has actually had had its advantages. So, an example is an investor that actually ponders the probability that a company will report a certain earnings over growth rate over a period of 5 years or a 10-year period. And it's actually more apparent to actually ride out the short-term fluctuations in the share price itself. So by extension, this actually means that the investment returns are really likely to be superior, and that he will also be able to realize, or she will be able to realize, fewer transactions and or capital gains in terms of costs. All right. Now the sixth is really recognizing your psychology, your psychological aspect of investing. Okay. So very simply, the means that individuals must actually understand is that there is no psychological mindset that successful investors tend to have, but more specifically, the successful investors will actually focus on the probabilities of economic issues and let their decisions be ruled by the rational thought process as opposed to emotional thinking. Okay, so you've got more than anything in terms of investors owning emotions that can actually be the worst enemy of all time. All right, and Buffett actually contends to that the key to overcoming emotions is being able to retain your belief in the real fundamentals of the actual business and not get too concerned about the actual stock market or the price move. All right. So investors should really realize that there are certain psychological mindsets that should really be adopted and have if you or anyone wants to actually be successful, and really to try and implement that type of mindset. So the seventh is ignore market forecasts. Okay, there is an old saying that Dow climbs a wall of worry. Okay, in other words, a spite of negativity in the marketplace, and those who actually potentially contend that a reasoning is just around the corner. Okay, and the market have actually fared quite well over a period of time, and therefore doomsayers actually should be ignored. Okay, now on the other side of the actual coin, it's just as many as external optimisms that actually argue that the stock market is headed potentially towards a higher point of higher points, and these should actually be ignored as well. Okay, now in all the confusions that Buffett's suggestions were that investors should actually focus on their efforts on really isolating and investing in shares that are not currently being accurately valued by the market. The logic that here is, that form of a stock that's in the stock market that actually begins to realize the actual company's intrinsic value. So through higher prices and greater demand, the investor will actually stand to make potential profits or a lot of money. Now, the eighth one is really wait for that fat pitch. Now, Hasselblad books actually uses the model of legendary baseball player Ted Williams as an example of a wiser investor. okay? And Williams would actually wait for a specific pitch in an area of the plate where he actually knew he had the higher probability of making a contract with the actual ball. So before swinging, that is. And you know, it actually said that this type of discipline can actually be enabled by Williams to have a higher lifetime batting average than any typical player. So Buffett, okay, in the same way, actually suggests that all investors act as if they actually owned a lifetime decision card with only 20 investment choices punched into it, okay? And the logic is that, you know, this should actually prevent them from really making mid-core investment choices, and of course, hopefully, by extension of enhancing their overall returns of their respective portfolios, okay? But the end result is that, you know, the Warren Buffett portfolio is actually really a timeless book that offers valuable insight to the psychological mindset of the legendary investor Warren Buffett, okay? And of course, if, you know, learning how to actually invest like Warren Buffett was as easy as reading a book, everyone would be rich, okay? But if you take the time and the effort to really implement some of these methods, okay, and, you know, some of Buffett's proven strategies really could be the right direction, and, you know, the right way for you to better in terms of your stock selection and being able to get better returns and higher rewards out of the effort and energy that you've put into trading. So, ladies and gentlemen, I'm very glad we got that out of the way. We covered all the topics for today. And of course, the end result is it's quite simple, you know, to be able to identify your own individual mistakes and to be able to utilize these mistakes not to make the same errors again. As I said, trial by error. Practice makes perfect. It's like riding a bicycle and falling off it. Your psychology has to be strong. You have to keep your head straight. You have to know that you're going in for business and you're going to close the business at the end of the day. All right? Or alternatively, you have your plan set. You're going to execute. You're going to follow your plan, and you're going to really identify key points of where you can enter the market and then exit the market having some sort of reward with it. So thank you, ladies and gentlemen. I very much enjoyed conducting this webinar today. If you do have any questions, I'll be more than happy to answer anything that you guys might have. Well, you're more than welcome for my time. If you ever want to, of course, ask me any sort of questions, ladies and gentlemen, I'll be more than happy to answer. You can always follow me on LinkedIn. You can find me on there as Raad Aswani. Any sort of industry-related questions, if I can assist, then of course I'll be happy to answer anything you have. All right, thank you very much. How to start studying technical analysis? Well, look, I should be running, if you look for myself on investing this week, I believe on Wednesday, we have 3 different parts this month that are going to take you from the core basics all the way through to the end. So you're going to get an understanding of how technical analysis works. We're going to be covering a number of different indicators within that series itself. It should be a 5-part series, but the first 3 parts are out this month. So by all means, do follow us, come over, sign up to it, and see what else you can learn that you may not have already known. Okay, well, thank you again for joining me here today. I look forward to seeing you all again sometime soon. But again, thank you for attending our webinar, ADS Prime. It's an educational webinar. You can follow us any other time. Thank you.